All right, we're live.
Hey,
Hey, everybody, welcome back. We're happy to be back. Rob dodged an accident on the way home, so
well, nearly dodged it, got caught in it, but yeah, managed to. Wasn't
yeah,
involved in it, so
yeah. So that's good. So you're still alive. I like that. Otherwise, I would have to do this alone, and I'm scared. So
that would be rubbish.
yeah. Just me would be completely useless. No fun, nothing cool, nothing happened. I want to say hey to everybody in the chat. By the way, I see Jay is here. Golden Goose, that's Plippy, right? We
It is
got, let's
the annoying
see.
dude.
Oh, Dave. I see Dave is there. Imre is there. Cool. All right. Cool, guys. So today we want to talk about the CPI. Obviously, the CPI report came in, and it was actually almost all the numbers were exactly to expectation. I'm going to share my screen here and just go over that real quick. So the expectation for the overall CPI was 6.5, and we landed on 6.5 right here. So it's down from 7.1 from last month, and obviously you see the trend is going down pretty fast. It's actually going down faster than it was coming up, at least on the CPI. So the question is that good? Is that bad? Is it dangerous? Is it safe that it's going down that fast? We will discuss that briefly soon. We do want to look at the inflation rate month over month as well, which was also one expectation, which is down 0.1%, which is, spot on what they were expecting, which is, I guess that's neutral.
It's deflation. Zero
Yeah,
is neutral.
well, exactly. But
I guess
in terms of expectations, right?
they're only doing it up to the closest 0.1, so it's kind of hard to gauge exactly. But minus 0.1 is minus 1.2% a year or so.
Yeah.
So
Yeah.
it is negative inflation. It's not.
Precisely.
There is no inflation now. Basically, it's
Yeah.
as I've mentioned a few times. Like
precisely, we're stuck where we are basically.
Down quick.
Yeah. So let's see. The core inflation as well is coming down very fast. It's 5.7 now. It's done these double top things here, which is kind of interesting in comparison to the CPI, which we just had a big. It's like we have a camel here, and we had a. Wait, what's the one with one thing called?
Dromedary.
Yeah. Okay. Right. Good. Yeah. So we got that. So I'm gonna go back just quickly.
Yeah.
So that's down. What is not down though? Actually, let's do the producer price is also down. So we're seeing production being cheaper as well, or not cheaper, but inflation is going down on it.
Yeah, this is kind of more. Well, this is more signaling the economic slowdown than the actual CPI, because the CPI is made up of a variety of reasons why prices are going up and down, but the producer prices is a direct it's a direct measurement of what people are charging, and if that's going down, it's a sign of economic weakness.
Precisely. So we're seeing everything going down, almost everything. Food inflation is still, it's coming down, but
coming down.
It's coming down, but it's not coming down as fast as everything else is.
What we have to consider is when food prices spiked, and that was April. Right, March, April. So no, in terms of the inflation rate, I'm talking about prices.
The rate. Oh yeah, the prices.
Prices spiked sort of around March, April, May. So at that point, that's when we're going to have a period where basically everything was cheaper a year now than it is a year ago, and so that even this rate I expect to start maybe accelerating down a bit more than it currently is.
Yeah, precisely. Yeah, so we're it's looking like the Fed is getting what they want in terms of pushing things down. The question is, oh gosh, I forgot what the unemployment numbers were. They were released like 2 days ago. I can't remember what it was. Oh well. Either way, I think I think so what they're trying to do here is exactly what they're managing to do, which is obviously good. The question is it going to be good for the market? And that's kind of where I'm trying to get at. What's going to happen? Are we going to see a further leg down on stuff here in the future, or are we looking at some kind of reversal of the markets already? You know,
I very, very much doubt that this is the reversal or the final bottom. I don't see a V shape. I see a U bottom. However it comes in, I see a significant period of, even in the best case, which is a soft landing, we would see a real U-shaped bottom to the chart before it then begins to move up.
right?
That's if we get a soft landing. By definition, that's the soft landing. That will be it will be a period of accumulation. It will be cheap prices for a significant period of time. The way that we get a V shape is via a hard landing.
Yeah,
and
precisely.
have we seen that yet? We've seen it multiple times in crypto as entities have blown up this year, but within that, those blow ups have sort of been unique in that they've been crypto fundamentally led, but and then on top of that, the overall crypto market has largely followed macro. Now, I think we're starting to see that correlation start to break, which we tend to see when Bitcoin wants to head upwards. However, it will still be tied in to fundamentally, but to the fundamental drivers of the market. And just like the COVID crash, if I don't think Bitcoin had any real, it didn't really want to go to $4,000 in March 2020. It happened because the wider market had a complete total blow up. Could that happen again? Well, it's the numbers here don't really suggest soft landing because they're coming from such an elevated price.
Right.
It's like think of a toy plane or something where it goes out of control and it goes vertically upwards. What happens afterwards? It comes vertically downwards and slaps into the floor. We're not in a U-shaped sort of trajectory. A lot of things are getting worse very fast. We talk about the inflation rate's clearly coming down. We've seen from when the Fed started raising rates to when the Fed started talking about pausing, that the inflation rate carried on going up even into the hikes, and then it flatlined while we were hiking, and now it's coming down as we're hiking. So there's a lag, and we're now only seeing this drop in inflation. We're now seeing the hikes from 6 months ago, not the hikes today. The hikes today will still be coming into effect, rolling over in 6 months' time.
Yeah, it's a very lagging thing.
So there's no stopping this train. You've currently got a lot of distressed lenders. You've got a distressed bond market. You've got a whole host of things that aren't happy in the market, and we haven't even seen the long-term effects of the rate hikes yet.
Yeah.
Not to mention a period of pausing. So even if they start to pause now and they manage to catch it early enough that we kind of have this soft landing of inflation, they're still going to have to cut rates because the market is screaming out, we can't sustain these interest rates. We can't have economic growth under these market conditions.
Yeah. I did just find, by the way, the unemployment rate. It's 3.5 from 3.6 last month, from 3.7 the month before that.
It's going to stay low for the time being because there's such a labor shortage. There's so much demand still that the Fed wants to intentionally wants to crush, and that ultimately means taking those companies that have employees and stopping them from hiring, or in many cases firing. So the Fed are telling you, we want to cause a recession. That's their intention, and their actions show that this is not soft landing behavior, and this inflation is going to mean revert far quicker than people expect. I think it already is flatlining, going down quicker than people expect, and that's it. This was predictable from 3 to 6 months ago. You could say, yeah, this is probably how it's going to play out. Nobody knew where the ultimate peak was or when it would be, but the behavior of such a high spike in inflation will be followed by an equal collapse in inflation, because it's a year-over-year measure and we don't have sustained inflation. Everything is coming down in price.
Yeah. I actually had a quick discussion with Jay, one of the guys at Crypto Talks. He in the Discord just before this, and we were talking about my friends. They have a car dealership down here, just where I live, and I was telling him that in like March something, I started warning them that you got kind of prepare for what's coming in the winter at the end of the year, because if you have a huge, if you stock up on cars during the the summer and all that, and then going into the winter, prices will probably start coming down pretty hard on the used car market. And so I think they prepared fairly well, I think, with what they did, what they had. I need to go down there and talk to them again here this weekend, I was thinking, because I know they brought in a car from a person that I know that they were going to sell, and I think they've lowered the price twice, but they have to lower the price. They can't lower the price faster than the price is actually going down, so they're not. They can't sell it, and they didn't buy it from this friend of mine. They just said, okay, we'll sell it for you, basically, which is a smart way to do that. That's a way to dodge that
gap,
the loss of to dodge that for them. And it's still not sold, and that's one of those cars that small automatic car that sells really fast in an environment like this, and they can't sell it. No one is buying anything.
So
this is in Sweden, by the way, for those who don't know.
This is around the world. This is globally.
Yeah, I'm just saying this is in Sweden.
but that trend, no, that's happening everywhere, and there is going to be a bear market essentially in car prices, and it's one thing which has absolutely exploded in recent years is, in the US in particular, is car loans. So the banks took the playbook from the housing market in the financial crisis, and they just applied it to auto loans, and we now have the whole collateralized debt obligations and tranches of subprime auto loans. And guess what, when they fail, because and this is it's like a fundamentally riskier asset as well, because unlike houses, cars don't go up in value. So there's gonna be
they did for a while, because
but that's temporarily.
Post 2020 was just
over. And not everyday cars, so now you're going to have this scenario where the default rate on cars, as a result of tighter lending requirements, of higher interest rates, of people potentially getting laid off, of people borrowing on credit cards, with credit card debts rising, that default rate goes from 2 to 3 to 4 to 6% very quickly on these crappy car loans. And you've got trillion. That's a I don't know, not trillion, but that's a multi-billion-dollar economy. Boom, poof.
Yeah, I'll tell you right now. I know because I used to work with these guys down here at the car dealership, and I know that the base rate the cheapest base rate that they could give out on a car loan was I think it was $4.95, which is it's kind of normal here in Sweden, like overall, for car loans. And they could push it down. I think they stopped getting kickback at like 3.45 or something like that. If they went below that, they could still go below that, but they wouldn't get anything for it, right? So, but now, last time I was there and I talked to them, it was at 8.95, and it was up 2% one month, then 2% more another month. I think it was, where it was 1 and then 1 and then 3 or something, like just boom, straight up. And that's from a big bank like Santander, for example. Like it's instant.
Yeah,
it's like a punch in the face. So people can't afford to buy anything. And here's my question with all of this, right? Or my thinking. We're seeing everything go down. Inflation's going down really fast. We might even go deflationary on many different metrics, right? Which is maybe not great.
Nope.
The question is as well, if that happens, if the Fed notices that the inflation is going down so fast on, let's say the core, for example, they're aiming for 2%, I believe, right?
Yeah.
We might see something below that, or like even if they start noticing, like, oh wait, we're already at like 2.5. Let's halt the rate hikes or whatever. It's still gonna keep going down for half a year.
They should be pausing rates imminently. They shouldn't do any more hikes. They've already hiked, I think, two times too many. Well, maybe 1 time too many. They could have cut one of those 75 basis points out. If the last 3 months had been 25 basis point rises, and then it could have been a bit more sustained.
Yeah,
they went up too high, too fast.
Yeah, precisely.
After delaying rate hikes too much, they should have had. They had the rate cuts. We had the COVID crash. You had that recovery. 2021, all through 2021, they should have been gradually 0.25%. And so when they started from 0, they should already have been at 2.5, which would have tempered and stopped the peak from being as high as it was.
Yeah. I think if they wanted a quote unquote soft landing, which is what they were talking about the whole time, maybe they should have raised it fast until they got up to maybe half of what it is now, and then started with like 50, 25, and then started kind of to smoothen that curve out. Because if they want a smooth landing, they need a smooth rise. That's at least in my head, that's what they should have done. But I guess they're like, boom, straight up. And we're gonna see what we can look at the charts too for the CPI, or for the core at least, and we'll see that like it's straight up and it's starting to come down straight down now, which means that
Flippy's asking when moon.
I know. I put the question up on the screen.
It's like when moon will be after all of this has played out. Like there is no moon soon. Moon is not happening.
This actually pulls me into, because we're at 18 minutes and we're going to try to keep it under 30. This actually pulls me into the next part of this, where I wanted to, because I feel like we've gone over most of the stuff on the CPI and we don't really have any questions of it. Prippy is saying they were so aggressive with the hikes so they can switch on their printers earlier.
I don't think so. They were aggressive.
I don't think
with
they
the
want
hikes.
to.
No, they were so aggressive with the hikes because they were so slow to react. That's why they've been so aggressive.
Yeah,
because they
precisely.
screwed up and they said they didn't. They waited too long. They were complacent. Like, how many people on Twitter did you see saying inflation's going to go nuts? This is going to happen. A recession's building, and the Fed going, "Oh no, we don't think so. Oh, probably not. Oh, we don't." It's like,
now I'll say this too. A lot of people on Twitter were saying, I remember this back in when we started seeing the inflation really going nuts. I remember people talking about, they were talking about. I hate when I lose words. They were talking about how COVID was like the thing that kicked it off. It's like, yes, but like a recessionary bear market type event was coming anyway.
I like to say catalyst, not cause.
Catalyst. That's the word I was hoping to find.
20 September, October 2019. I could talk for ages about it, not today, but there was a whole the repo market blow up, essentially. Well, nearly blow up, where you had essentially a whole lot of bank capital. So there was too much money in the system already, and it had nowhere to go. So banks started placing it into the repo market in the hundreds of billions of dollars, which is an overnight interbank lending market. For those that don't know what it is, it's not very well understood. It take a while to explain it, but that started climbing to the hundreds of billions from practically zero. It's currently in the trillions. Like well over 1 trillion, because there is all of this capital and all of this liquidity in the market that has nowhere to go. And it's taken these higher interest rates to give that capital somewhere to go by providing a proper yield for bonds.
Yeah, it's essentially, that is like a risk-free thing right now.
Yes,
being in there. It is.
That's for unless you think the US is going to default on its debt, then these high interest rates on cash, on these cash positions, are just risk-free money. And the more risk-free money you can make, the less you value asset prices, and so stocks will suffer. Stocks won't go up until, but similarly, when interest rates come down, bond prices will go up. Now, it used to be that when bond prices went up, stocks went down. We've kind of left that world for a while now, because stocks are seen as just as sort of good as an asset class and just as much of a store of value as bonds, because bonds have kind of lost their value because of
lost their
years of
or mojo.
Because of decades of really low yields and monetary debasement by banks. So stocks tend to go up along with bonds because the world's screwed, and that's an effect of low or zero interest rates, which inevitably we're going to come back to when all this inflation disappears, because we can't handle the debt at these high interest rates. Right. It all comes back to the same thing, the same circle of shit.
Yeah. Well, it is what it is right now. So, please, there's 7 minutes left. Yes, we know. So I like this comment by Jay here. It's kind of funny. If you want a moon, you need to go outside at night and look up.
And I'll tell you what, that's good life advice, guys. Like, obviously,
go outside.
Tune into Crypto Talks, but don't stare at charts. There's nothing happening in them.
No, let us do that, and then come watch us for half an hour every day, and we will show you the charts, and then you can hide, go watch a movie, Netflix, and chill with the waifu. It's gonna be good. It's great.
Even at the moment, some green's happening. Come on, how sustainable is that gonna be?
Yeah. Speaking of which, I'm gonna actually open up here because I wanted to go into the S&P 500 and the Nasdaq real quick and just show you what's going on right now and what we might see happening if prices keep going up. We have a small pump right now in the markets. I'll also show you a quick look at the Bitcoin, the charts, just because, it's Crypto Talks, it's not SPX Talks. So let's see if I can find how to share my screen. Clickety clack. There we go. All right, so I just made some really quick trend lines here, and these have been here for ages now. I think you must have seen them before, but essentially, we've been in this ever since the top back in January 2022 on the SPX. We've seen this bounce on this 3 times now. Arguably, we can even pull this down to here. Get that? That's an anomaly. But we're getting close to it. And we see the same thing happen on the Nasdaq. It's just slightly different. It needs more to get up there, but it's
if you look at the Dow Jones, then what's kind of interesting to see is that the Dow Jones is much closer to its all-time high than the S&P, and the S&P is much closer to its all-time high than the Nasdaq. Yeah,
precisely. But as you can see, the thing that I noted about this one is that it kind of smoothened out the bottoms here. You see this new trend line, and now we're looking at a very much higher low in the past month from before. So it's showing some kind of let's call it strength here. It doesn't necessarily mean that we're going to see this huge breakout. However, at least we're retesting this line right now on both these 2 major, and then yes, go on.
The Dow did see, the Dow is the more interesting one of the 3, because whereas this was still making lower highs and lower lows, that per DJI
DJI
either way,
right?
New York Stock Exchange one. There you go.
This one.
So if you look back into December, it's making higher high. It's making a higher high rather than a lower high. which
precisely. We're
is
seeing that. And this is a
so,
huge move compared to, I mean, the difference of the Dow Jones with and the SPX and everything this is clearly not as heavily. It even had an all-time high is not even back in the chart is completely different, right?
So what we're seeing, and we see pretty clear inverse head and shoulders break there, is the larger caps, the more defensive stocks, the bigger names, the safer bets are the ones moving, not the more speculative plays. The market is not ready for speculation. The market wants this is a flight to security, and this is essentially the Dow Jones doing this while the Nasdaq continues to kind of look like crap is a perfect example of the expectation on what will happen with Bitcoin compared to altcoins. Is that the first mover will be Bitcoin? That's safety. That nobody's going to be pumping shitcoins thousands of percent for a while. There'll be pumps, sure, but the safety will be in the bigger plays, and that's exactly what we're seeing with the Dow compared to the S&P and the Nasdaq.
Yeah. So I wanted to actually Plippy or Golden Goose actually just mention this, that BTC broke above a 15-month downtrend. So I actually did some stuff here, and I messed up my chart because I made a nice arrow there for the volume as well. So for Bitcoin here, we're looking at one big trend line break here, which is the one I think he's talking about right here. And this is on the logarithmic chart, by the way. When I look at long-term stuff like this a year or two back, I use the log chart. That's me. I know people use linear, but I prefer log. I prefer the log here. But either way, we've broken two trend lines very recently. Last week we broke this one. This week we're breaking through this one. Right now it hasn't closed yet, so we can't really say that it's broken out completely, but it's a good sign. And then we also have, here's the an overall bottom that we were bouncing on before, and right now we're kind of sitting above that too. If we even turn on the Bollinger Bands, we're above the middle line right now. So if the weekly closes above here, it's going to be, well, it did here too and here too, but if it does, there is, I don't want to say, I don't want to make predictions, but there is a possibility that we can start moving above here.
No, let's say
and staying above.
He's absolutely right in saying that Bitcoin is currently showing more strength than the stock market. However, that is with the caveat that in terms of the overall trend, the long-term trend, it looks much weaker. So yes, it's currently making a bigger move and showing some short-term strength because of how utterly battered it's been for so many months. Yes, by all means, this trend could continue further than people really expect. But at some point, I think there's going to be a fairly sizable retest of this sort of this demand zone, unless something fundamentally changes. And I don't know where that is.
Like the TA we've done before is that we need to go and retest this trend line. This is the long term, ever since the top, and it anchored over here in March, at the end of March. So getting to this one is the thing that I've always talked about, that we might need to retest this, or we will have to retest this and see what happens. And honestly, the move up from where it is right now to retest it, if it does it next week, we're looking at, well, 20, I think it's 22% or 21% or something from where it is right now. And we got time. I know, Rob. We only have a minute left. The last thing I want to go over before we shut this down, volume is turning around for the first time. We got 2 weeks in a row right now where the volume is up, at least on Binance. It hasn't done that for a long
Thursday.
time.
So Thursday, so this should be a sizable week. Which is good.
I like how you said that we only have 1 minute left, and then when you started talking in your camera, it lagged and it made you talk really fast. That's perfect. All right, so that's it for today, guys. Thanks for coming around. Hopefully we will be able to do a video tomorrow. We are unsure right now, but we'll see. Otherwise, I'll record an educational video for everybody. That one. The next thing I'm going to do is probably about the candle charts and how to read the candles and the construction of the candles and wicks and all that. Cool, guys. Well, thanks for coming around, and we'll see you in the next one.
Yep.
All right.
Bye, everyone.
Bye, everybody.